What is going on, investors? Hopefully, you guys are doing well out there. It is time to keep earnings season moving right along. We got a big one today. We got AMZN.com, ticker symbol AMZN. The company reported their Q3 earnings after the bell. Also gave us guidance for the all-important fourth quarter as well, the quarter that we're in, the holiday shopping season. Amazon's biggest revenue center. We'll compare it to where Wall Street has the company coming in as it relates to guidance. We don't need that page because we're going to be taking a look at all the financials as well. The revenues, the profits, more importantly, the cash flows as well. Even more importantly than that, you guys have to see this. We've got the North American business, we've got AWS, and we've got the international e-commerce business. Some very, very exciting things going on there. We'll take a look at the trends, and then we'll also take a look at the growth rate from all the business units. And then we'll come over here and look at this from a technical perspective as well. Stocks have been selling off more recently. Talk about if this one has found some footing from a technical perspective. Now, year to date, shares of Amazon are up about 40% over the past year, though. Shares have really more or less been flat. Revenue coming in at $143.1 billion. That was 12.6% growth. Wall Street was expecting $1.54 billion less than what was reported. The low end analyst was at 138. The high end was at 143. And that's where Amazon came in. They also gave us fourth quarter guidance as well. Revenues expecting in the all-important fourth quarter, the holiday shopping season, between $160 billion up to $167. Now, that is actually probably a little light because the consensus estimate is at $167. The high end is at $172. Now, what's probably coming in a little hotter than expected is your operating expenses, or not your expenses, your operating income. So this is almost your profit before you pay taxes and those types of things. Operating income expected to be between $7 and $11 billion. Now, just for some context, the company just put up a quarter where they did $11 billion in operating income. So they're continuing and going to see that trend continue for the upcoming quarters. If Amazon hits the consensus mark, they're growing kind of in that low double-digit mark. We've seen Google hit this mark. We've seen Microsoft hit this mark. And now Amazon, which has a much larger business from a revenue perspective, is also hitting that mark. Very exciting, I think, for this company. Now, total net sales coming in at that $143 billion. Now, what we've seen kind of in tech, and Amazon's kind of a different kind of tech company. It's more of a retail company, obviously, is we've seen pullbacks in sales and marketing and G&A cost, and that's exactly what we saw over at Amazon. They drove down their sales and marketing cost while they drove up sales by over 12%. You love to see that. They also drove down general administrative cost as well over the last year. All your other costs, from technology to fulfillment to cost of sales, which naturally goes up as you sell more goods like Amazon did, well, all those costs rose. So over the last year, your total operating expenses rose by about $7.3 billion. That was offset by your total net sales growth, and your operating income exploded from $2.5 billion all the way up to $11.2 billion. A great quarter for Amazon from a profit perspective. Now, again, they've got a long ways to go because we're talking about a $1.2 trillion company with $11 billion in operating income. But again, we kind of floated over these numbers almost like we're numb to them. I want to remind you, this is a company for 3 months. We're not talking about 3 years or 300 years. We're talking about 3 months, $143 billion. Now, it's not all software and AWS margin, right? Okay, you do have quite a bit of cost of sales. In fact, it's about half of this, but that still leaves $75 billion to be chewed up by the other expenses. For the most part, it is, but this company is absolutely turning a corner from an expense perspective. You'll get a better sense of it when you come down here and look at this is a cash flow statement for Amazon, and you pull down a net income number. Net income is after you pay your taxes, after you pay the interest on your debt. It is the bottom line, if you will. It's usually represented by two black lines on a statement of operations or a P&L statement. So here's your bottom line. we'll call that $9.9 billion. You pull that to the top of a cash flow statement. Amazon throws their cash balance up here, which most companies don't do, but you pull down your net income here and you get to add things back in like depreciation. A company that's building a lot of warehouses, has a lot of employees, a lot of equipment, a lot of stuff, well, they're going to have quite a bit of depreciation. You have stock-based compensation as well, other things that you get to add and subtract. Take a look at your cash flows from an operating perspective, up to $21 billion. We've covered Google. We've covered Microsoft. They're closer to $30 billion. I tell you what, Amazon is knocking on the door, and the valuation over at Amazon actually is south of those companies. Now, again, gross margins not nearly the same, cash balance sheet, all those types of things. Not trying to compare these companies, if you will, but I'm just showing you, man, these mega cap tech companies just generate tons of operating cash flows. Now, very important with Amazon, this is not a software company per se, so they're spending a lot of money on purchase of property, plant, and equipment. But notice over the last year, again, on a quarterly basis, 3-month basis here, last year, you spent $16.4 billion on property, plant, and equipment, down basically $4 billion to $12.5 billion. You see for the past 12 months, and I wish more companies did this, give you like a trailing 12-month view into their cash flows. Notice our purchase of property, plant, and equipment went from $66 billion down to $55.7 billion. So they're burning through less cash as it relates to property, plant, and equipment. So this $21 billion goes longer as you come down to the financing activities, and the company really is not doing a whole lot. They're not doing these mega buybacks like you're seeing at Microsoft and Google. They're really investing in the purchase of property, plant, and equipment, and they're paying down some debt, some kind of short-term debt. They paid back about $8 billion and about $35 billion over the past 12 months. They're constantly kind of borrowing, refinancing, lines of credit, those types of things at Amazon. So this cash flow is going a long ways. If you're able to repeat this for subsequent quarters, keep those operating expenses in check, keep the investment in check as well on your property, plant, and equipment, things are looking pretty darn good for Amazon, needless to say. Now, here is the key to this company, and it's always been the key to the company. Everybody talks about AWS, and for good reason, and we'll talk about it here in a second. But the key to this company pushing from a $1.2 trillion valuation up to $2.2 trillion or $3 trillion is they need their e-commerce business to actually make money, okay? And what we're seeing in North America is a very positive trend. Look at this, folks. Your sales in North America, again, this is your e-commerce business, from $78.8 billion up to $87.9 billion. Look at your operating income. Last year, you lost money. You actually lost money buying on Amazon, okay? Amazon lost money selling you stuff. Look at the increase all the way to $4.3 billion. Now we're still very, very low single-digit margins from an operating perspective on the e-commerce business, and this is just for North America, but they are going to be getting rid of a lot of these employees. And if that makes you butthurt, I'll refute that in a number of different ways. A study came out yesterday that said 3/4 of Amazon employees have been hurt on the job and have had to take time off, and it's been unpaid. Also, Amazon's churn rate in terms of their employees is double the average that you normally see. In some locations in the country, Amazon is going to run out of people that are available to work for them. And so this is a company that can't rely on human labor. It can't. It's not sustainable. Does it work right now? Did it work yesterday and the day before? Yes. Is it going to work a year from now, 2 years, 3 years, 5 years from now? Absolutely not. You need more robotics. You need more automation. The more you do that, the more you can run these facilities 24/7, 7 days a week, less injuries, less cost. It costs Amazon $9 billion a year, probably now $10 billion a year, just to handle the churn of its employees. So they are going to be getting rid of a large percentage of those employees, or at least a percentage of them, and that should continue to increase the profits in the e-commerce business. I don't think, I'm not certain of this, but I don't believe this is ever going to become a double-digit margin business. business, but if you can raise this from really low single-digit margins up to kind of high single-digit margins, you've obviously got a winner there. Now, obviously, you've got work to do in international business. You've gone from $27.7 billion up to $32 billion. Your operating losses have improved here. You lost $2.5 billion last year. This year, more or less break even. So you'd like to see that continue to move in that direction. And then finally, you have AWS as well. From a revenue perspective, it's certainly slowed down, but you had a nice reacceleration in the operating income from 5.4 up to close to $7 billion. I'll show that to you more specifically here. Here's the AWS segment over at Amazon, and you're seeing that the revenue growth rate has slowed. We were at 30, we were in 20s, and now we've put up 2 quarters in a row at 12%. But what is nice is your operating income has reaccelerated from 5.7 to 5.4, 5.2, 5.1 to 5.3, now all the way back up to nearly $7 billion. That was 29% growth year over year. So yes, the revenue growth rate has slowed, kind of law of large numbers. I mean, $23 billion on a quarterly run rate is big for any business, let alone where it's kind of, it's actually the lowest amount of revenue that this company puts up among their two other segments. But from a profit perspective, just absolutely fantastic. Here's your international e-commerce business. Look at your operating losses. They continue to improve. They're moving in the right direction. In fact, they increased by about 96%. So you're moving in the right direction, and you still have relatively strong double-digit growth rate on those net sales. And then finally, here's your North American business. That's growing in the double digits, not nearly what it was maybe a year ago, and certainly during the pandemic, but still a very, very, very solid business. More exciting than that, look at your operating income. It was a loss, it was a loss, it was a loss. It was just marginally profitable, and then we put up 2 accelerating quarters of operating income. The company can continue to do that and at the very least maintain that. Obviously, that's going to be very good. From a business perspective, everything's growing about what you would expect. Third-party sellers, that's a high-margin business. The high-margin businesses over at Amazon are your third-party sellers because you're just collecting a commission fee, more or less. I say just, it's a little more complicated than that, but it's basically a commission fee. You like to see this growing in the double digits. Your subscription basis, that's your Prime membership. That's still growing at double digits. Your advertising business, also very high margin. Think of Google, think of Meta. That is the fastest growing business. And then obviously you have AWS as well, which again is a much more mature business. But we're seeing this company has got a $40 billion ad business. They've got a $40 billion Prime business. They've got a third-party seller business, which is larger than almost every other e-commerce company combined. Now, finally, we'll look at the technical chart. We are just consolidating a range. The low end of the range is down here at about 115. The high end is at 140. Currently, shares in the after hours are trading at 125. Until you get a break one side or the other with Amazon, you have to assume that it's going to accumulate in the range. And the stock has done this. I remember when we were doing our channel, when we were stuck in this channel per se with Amazon, it was just stuck between 80 and 100 basically. And the stock stayed there for a long time, finally had a breakout, consolidated at a high range, broke down. Now we're consolidating more or less in a range between the two. So you have a range below and above. And until you get a break one side or the other with Amazon, I actually think you could probably lightly accumulate shares in this range given the results. Okay. If Amazon had put up worse results, particularly in the North America business, and if AWS profits were starting to slip, then I would probably say, just wait until a better opportunity. But this is a company that's moving in the right direction. We weren't sure about Andy Jassy, certainly following in the footsteps of Jeff Bezos. Not an easy thing to do. He's done a nice job controlling cost. You certainly saw that on the operating statement, the fact that they were able to cut costs on sales and marketing while still driving sales. We'll see how the fourth quarter comes. This guidance is a little disappointing, but the company is certainly guiding for operating income and profits, which are above expectations. Shares of Amazon in the after hours after the conference call up about 4.5%. We'll see where shares trade tomorrow. We'll be back. Speaking of tomorrow, we'll be back on Friday for our Fang Stock recap show. Until then, hope you have a wonderful day, and we'll see you again tomorrow. Good luck with your investments.